The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A trade offensive has Wall Street on the defensive. A wild week wraps up here in U.S. financial markets. Live from New York, I'm Romaine Bostic.
And I'm Alex Steele. What a crazy day. Forget the week, just today.
Okay, I'm still focused on the last 4 days.
Oh, okay, well that too. I'm focused on today because that whirlwind that we saw within the equity market was pretty tremendous. Now you have the S&P up 0.4% as it seemed like Fed Chair Jay Powell really calmed some nerves. NASDAQ 100 up 0.5%. Now there was a bit into the bond market, Romaine, as we saw the equity sell off earlier in the day, but now we're seeing selling. We have yields up by 3 basis points. The VIX is kind of calming down, Romaine, but it does feel like that elevated volatility definitely here to stay.
Well, I'm going to be a bit of a negative Nancy here because despite the bounce that you saw on that screen, this has still been a monumental week of news out of Washington, and that has solidified a monumental week of moves on Wall Street. The dollar still having its worst week since 2022. The VIX still at its high of the year. Short-term Treasury rates still near their lows of the year. The unabated enthusiasm we saw in January that has now flipped to unanchored fear here in March just 2.5 weeks ago. More than 300 S&P 500 stocks were boasting year-to-date gains. As of today, more than 300 S&P stocks are now sitting on year-to-date losses. And the big reason why is what's come out of Washington. Traders are betting on more declines with uncertainty out there. The cost to buy protection right now through the options market hitting the highest in at least 2 years. No real sympathy emanating from the White House and no real help yet coming from the Fed. Jay Powell today acknowledging the market skittishness, acknowledging the economic uncertainty, but says he sees no rush to act.
While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
Jay Powell in his shadow speaking a little bit earlier. Meanwhile, what was supposed to be a bit of a coming out party for crypto being soured by the broader market sentiment, an executive order by Trump to pursue a strategic crypto reserve. Well, that fell a little short of the details that the faithful had been looking for. While most crypto assets are higher than where they ended last week, they're well below those record highs set back in January, Alex.
I mean, talk about your whippy action. So you're taking a look at 1% moves to the up or downside for the S&P for 7 straight days in a row. Now, we haven't seen that since August 6th of last year. And this just shows what has happened to the market, whether in tech or the broader market since the election. It's a normalized chart. The orange line is the NASDAQ 100 and the S&P is the white line. This is the election. You saw the rally, and here is where we sit now. You have the NASDAQ 100 sitting in correction territory. Then S&P was getting pretty close. We managed to kind of rebound off that 200-day moving average by just a touch. But a tremendous change from that animal spirits bullish move that we saw back in November, Romaine.
Yeah, and it is going to be interesting here how monetary policy factors into the equation. The Fed, of course, set to meet in a couple of weeks' time, a quiet period set to kick off in just a few hours. But before that, we did get a chance to hear from Jay Powell and hear with some more context and what we learned from him and how the Fed is now facing that dreaded transitory question about inflation. Is Jonnelle Marte. She joins us right now from our bureau down in Atlanta. We heard from Powell today. He kind of reiterated, I think, what we heard from Williams and Daly and a few others over the last few days and weeks, which is, yeah, we're all aware that everybody's on edge, but we actually don't think there's any reason to do anything just now.
That is right. He did acknowledge that there are kind of clouds in the distance, that the outlook is a little bit gloomier right now. But he stressed that monetary policy, in their view, is well positioned for that uncertainty. So they brought rates down a full percentage point at the end of last year. And now they're saying, OK, well, inflation is still not back to our target. We want to get it there. And we think we're in a good position in the sense of we'll wait a little bit for inflation to keep down. They want more clarity, more confirmation that inflation is headed in that direction, going to hit their 2% target. And also they want to know what is going to happen here in the U.S. fiscal policy, as we saw the headlines this week. So much uncertainty about what's actually going to happen.
Well, when it comes to us here, Jonnelle, the idea of where inflation is going, and we know the trend line has been working in the Fed's favor, but of course a lot's changed over the last 7.5 weeks or so with new policies coming out of the Trump administration. At what point will the Fed have to start paying closer attention to that? Are they going to wait until that shows up in an official CPI report or a PCE report?
So they are going to be paying attention. So, I mean, clearly these policies that are being discussed and implemented and then delayed are things like tariffs or immigration control crackdown are things that on the whole could add to prices, could slow growth. Now, those are things that the Fed is going to be watching for. And if they do see it, then they're going to react. But of course, as you mentioned, they're watching the data. They don't want to react to a policy that could change tomorrow, could change this afternoon. But they will be watching to see how it all plays out in the economy. And they're especially going to be watching what people make of it, what consumers make of it. You know, inflation is really top of mind right now. We're still dealing with it. And any sign that people are expecting these price pressures to continue or get worse would be problematic for the Fed and could make it harder for them to, for example, respond to slower growth concerns. So there's definitely a lot to monitor. But I would say that they're going to be waiting for that to actually show up and maybe for something to stick. They want to know what sticks. Right now, it's hard to know what direction the economy could head in.
All right, Jonnelle, thanks a lot. Really appreciate it. Bloomberg News, Jonnelle Marte. Thank you very much for the setup. All right, here with more context on the moves we're seeing in today's market, Aoifinn Devitt, a senior advisor and market strategist at Moneta. Aoifinn, what is the best course of action with this kind of volatility and uncertainty in the markets?
Well, I'd certainly say, unfortunately, the action is usually do nothing because it's simply general investors do not have the time or the ability to react in real time to these kind of swift movements. It is time to reflect on a portfolio, look at where it's exposed, ensure it has exposure across the board, across the cap spectrum, and ideally globally. What we've seen this week, despite the fall in US markets, has been a real renaissance and a kind of giddiness and optimism in Europe. That is finally time for the European markets to really rally. We've seen fantastic numbers come out of the Hang Seng and general optimism in emerging markets too. So I'd say this, for every action, there is an equal and opposite reaction, and that's what diversified portfolios are for.
So to that point, if Europe is going to see its moment, is that a European exceptionalism at the expense of U.S. exceptionalism now?
No, I wouldn't say that. I'd say it's European exceptionalism against the odds or against the worst expectations. It did seem that Europe was essentially being written off for so many structural factors, too high regulation, slowing birth rate, and in general, just lack of innovation. And now that seems to, some of that is still the case, but there certainly has been a reaction to the Trump foreign policy and to tariffs. And that seems to be getting a coalescence around the need to spend more, perhaps, and actually stimulate economies from the fiscal side. We know the monetary side is already underway. There have been 6 cuts for the ECB, the last one just this week, and 6 predictions of economic growth slowdown. So they are reacting ahead of the data, I would say, while here in the US, the Fed is waiting for the data, and that may be too little too late.
6 straight weeks now, Aoifinn, that we've seen European stocks outperform the US market. I guess the question, though, becomes what happens when Washington policy turns its attention much more squarely to Europe?
Well, I think they're going to look at the other areas where the policy has been turned. They're going to look to Mexico and Canada. They're going to see this on again, off again unpredictability. And they're going to start planning. And they will have the benefit of a little bit more forward planning. And there will be workarounds devised and there will be alternatives devised. None of this is done in real time in a very short order. But I do think that they've been given the call now, the siren call, that something has to be done, that Europe cannot rely on the US, whether from a military standpoint or to be reliable when it comes to trade. So I think the Europeans are very quickly getting their act together to respond.
Part of the enthusiasm, at least over the last couple of weeks that we've seen with regards to European assets, is this idea that I guess that fiscal leash that has been so pronounced in Europe appears to be loosening or lengthening, if you will, largely because of concerns about defense readiness, military readiness, and the need to spend more. How much of that is going to drive that European trade?
A lot of that is already driving the trade. There's, as I mentioned, there's kind of a giddiness or euphoria in Europe. Some of your columnists mentioned that when they were on the ground there in Frankfurt. It is high time. There's talk of a 900 billion spending package, even close to $1 trillion. And that's simply unprecedented in this frame. So I'd say that has actually become the galvanizing force of J.D. Vance's speech in Munich a few weeks ago, has been that there is now a sense of new energy in Europe. There have been elections, or even getting ahead of those new governments coming into place. So I think that will drive Europe. I think there's also just been the simple valuation mismatch, and the dislocations in Europe are finally getting the attention of investors who are taking profits in the US and looking to build some diversification. Equally, a weakening dollar is another good time to want to build some of that currency exposure into the portfolio.
There's been a lot of talk, though, in the U.S. about, is there a Trump put or is there not? We seem to be learning that potentially this time round there isn't. What do you guys think when it comes to, say, how policy is addressed?
Well, I think there's an unwritten and a written rule regarding that. I think there is most definitely a Trump put, even though we had Scott Bessent this week talking about the divorce between Wall Street and Main Street and how tariffs were designed to protect Main Street. I think everybody knows that Main Street is very dependent on Wall Street if we look at where retirement savings are held, particularly in the US with the broad diversity of equity holdings. So I would say those two are inextricably linked. And there absolutely is a Trump put, because nobody wants to see markets crashing and the destruction of value that will bring. And if that moment comes, it doesn't matter what the monetary policy is, it will be impotent to change the mood in markets at that point.
So where is the Trump put? Like, is it correction territory? Is it bear market territory? Like, how do you guys think?
Well, I'd say we're getting pretty close to it now, and that's exactly why tariffs have had the stay of execution. There is a little bit of let's see where the chips fall after this quite a tumultuous week. It's probably particularly tumultuous in terms of on again, off again news on tariffs. So I'd say let's see where the chips fall, and I think next week there will be a reckoning and perhaps some re-entering into the market. We may have already reached that point.
All right, Aoifinn, always a great conversation. Aoifinn Devitt, Senior Advisor and Market Strategist over at Moneta, as we continue to barrel towards the closing bells here on this Friday afternoon, a Jobs Friday, and ostensibly, at least here at Bloomberg, a celebration of International Women's Day, and that is an excuse to look at some of the trends in the labor market and, well, I guess what we're looking at there, which is a slight narrowing here of that employment gap between men and women, particularly when it comes, of course, to women in their prime earning years, 25 to 54, a narrowing of the gap. And a big question here is how we continue that narrowing. Emily Oster has spent a lifetime devoted to this question. She's a professor of economics at Brown University and the CEO of Parent Data, a data-driven guide to pregnancy, parenting, and beyond. Emily, great to have you back on the program. We put up that chart here kind of showing the gap sort of narrowing when it comes to women and men and their participation in the labor force. And more importantly, the idea that there has been progress, but if you look closely at that chart, you'll also see that gap has kind of stalled to a certain extent. It has narrowed significantly from the past decade or so, but over the last couple of years, it has kind of been somewhat stagnant. And I am curious as to what sort of gets us back towards the progress that we had been making.
Yeah, I think it's a great question. One thing you could ask is, where do we expect to land? Given the role that women relative to men play in childbearing, I don't think it's realistic to expect to get to exactly parity, but there are more things we can do to get closer to that parity. And I think one of those things, this is a lot of what I think about, is, how can we support women staying in the labor force during their childbearing years? So we expect people to take some time off for childbearing. How do we get them back? And that's where I think there's really a very significant role for paid leave, for options that allow people to ease back into the workforce. And I think if we can make more progress on some of those things, we'll start to see more and more of a narrowing of that gap, because I think many women, majority of women, would like to be in the labor force, at least to some extent. And the question is, how do we get them there? And then how do we keep them there?
Are you confident, though, that progress is going to continue, both in terms of whatever the government helps to facilitate, but more importantly, the ability of corporations to continue what they've been doing and to do so publicly?
I'm not that confident. I mean, I think we have seen a tremendous amount of move in this positive direction. I wish there was federal paid leave. At this point, though, many states have stepped up there, and many corporations are offering excellent paid leave benefits to their employees, which is great. I have a concern, like I think many people, that some of those things may be clawed back in the next years. I hope that they are not, in part because I think it's good for women, but also in large part because I think it is good for corporations. You put a lot of time into training people, into giving them the skills to work in the firm. If we lose people because we aren't willing to compromise or to allow for a reasonable amount of leave, we're going to lose those people that we've trained, and that's just basically a waste.
What about the importance of paternity leave? That you can now have men take leave, and in some cases it can be weeks, months, or even 6 months. What's the importance of that? Because as a woman who's had a child, if men start to do it, that helps to equalize it, right? Maybe that gap won't even need to be there anymore.
Yeah, I think we've seen a lot of different kinds of evidence about paternity leave. Many of our peer countries have good paternity leave. Many corporations now have good paternity leave. And there's absolutely good evidence that giving men leave can improve health even of mom if the leave is flexible early on. So I think there's a lot of good reasons for paternity leave. And one of the things we do want to consider is that many of the countries that have done this most successfully, like Sweden, have actually enforced the need for there to be paternity leave taken. So if we want to be, I think there's a caution here about making sure that when we provide leave, we actually make it really something people should take or are expected to take, rather than saying, oh, you could take leave, but of course, dads don't usually take leave. We really want to make it something that is in the expectation, and that's how we're going to get more uptake and more equality.
Right, because then there's a competition of like, I only took 1 week, I took 3 weeks, and that becomes a different kind of story. You mentioned employee retention. I was speaking to an economist earlier today, and they were basically saying that the idea with the labor market is if people quit, they're just not going to hire, but they don't want people to necessarily leave because they don't want to spend that time and energy on hiring people right now because they don't know what the economic backdrop is going to look like. What are the best retention policies?
The best retention policies are making sure that your employees are happy. And we know that so much of this family benefit stuff is part of how you keep employees happy. And whether that's leave or whether that's being supportive of some type of flexible schedule when people need it, I think there are actually a lot of ways, even beyond this initial period of parenthood, that companies can be more family friendly and more family friendly in a way that lets their employees mix work and family productively and lets you keep the employees so you don't have to, exactly as you say, hire new people. You have actually the opportunity to keep the people you have. But that requires a little bit of careful thought about, what do people need to support their combination of work and life.
And we've had this conversation on this program off and on over the years, Emily. And one component of that has come up a lot is this idea of entrepreneurship and also kind of facilitating the ability for women to basically start their own business. It's kind of basically cut out the corporate middleman, if you will, in this process. Is that environment, though, conducive to that right now for new business startups amongst women?
I mean, it's a complicated environment for business startups in general. I think we certainly see in the economics literature that there's a lot of evidence that women value flexibility. And so if you think of entrepreneurship a little more broadly as to sort of encompass not only starting your own business, but engaging in work that it has flexibility, some kinds of gig work, which is a little bit different, but has a self-employment, definitely see more demand from women for those jobs. I will say it's a hard time to start a business, no matter what your gender is.
All right, Emily, always a great conversation. Emily Oster there. She's the CEO of Parent Data and a professor of economics at Brown University. As we continue to count you down to the closing bells, this has been a week of tariff talk, and that was really apparent in the retail space. We did get earnings out of a few key retailers, including Gap, including Victoria's Secret. What do they have to say about the tariff situation? That conversation coming up next, right here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we're going to start with Mara Holdings. Rosenblatt starting coverage of the digital asset company with a buy rating and a $19 price target. The analyst says Mara is the market leader among public crypto miners. It says the company has taken full advantage of its industry-leading scale. Those shares up 6% on the day. In fact, actually heading towards their best week since November. Next up, JP Morgan getting a boost to neutral from underperform. This over at Baird, following some of the recent stock weakness out there amongst financial companies. The analyst at Baird now sees upside potential and calls JP Morgan a best-in-class franchise and with a premium warranted, but too pricey for new money. JP Morgan shares down about 2% on the day. In fact, they're headed for their worst week since 2022. And finally, Wayfair. An upgrade over at Jefferies to buy. End consumer demand may not be up to par, but the analyst says it could be a growth opportunity from Wayfair as some of the bigger clients do spend money on office, hospitality, and property management. Those shares up 6.5% on the day, and those are some of our top calls. We stay in the retail space, particularly on the back of some of those earnings by apparel companies like Gap, like Victoria's Secret. You see, Gap really did impress, but there are a lot of concerns here about the threat of tariffs and what that could mean for inventory and the bottom line. Adrienne Yih joins us right now, Managing Director and Senior Retail Analyst over at Barclays. So, Adrienne, before I get to the tariff thing, I want to start with Gap for one quick thing. This is a turnaround. I think that is undeniable. I guess the question is, do you think what Robert Dixon is doing in the last couple of quarters that we've seen out of this company, that is sustainable, that we are actually seeing a meaningful turnaround in what Gap can do?
The answer is yes. And what I'm going to say is I started my career very early on in the late 90s, kind of when Mickey Drexler was there. So since that time, for the past 20 some odd years, they have not had a merchant brand product, consumer-centric leader at the helm. There have been instances where they have done really well, but it's really been on the back of structural infrastructure operations. And so if you think about the last time the Gap brand had multiple quarters of positive comps, it was in like 2011 on the back of colored skinny leg denim. And so it's kind of a fad. Yeah. This is 7 consecutive quarters of consistent performance, 8 consecutive at Old Navy. 2 years of comp on comp it's a trend, right? It is a turnaround in play.
So my next question then becomes is what potentially disrupts that progress? Obviously, a lot of these retailers are dependent on imports. And of course, with all of the tariff talk, there's questions here about how they manage inventory over the next few months in a way that's going to be accretive to the bottom line and not extractive. How do they do that?
Yeah, I think the risk here is to try to, get inventory onto the books onshore before the tariffs hit. And that did not work at all in 2019. In fact, it actually ended up being a huge glut of inventory across the board, which then everybody had to liquidate in the back of 19. I think that retailers need to look at this and say, if I have a good brand, I'm willing to forego some low-quality, promotionally driven sales or take less risk on the inventory, meaning that they're not going to front-load the inventory. If they have to miss out on some sales for whatever reason because they can't get it in on time or there's some disruption, I think they have to kind of go with the notion that they want profitable sales growth. And in the event that they are bringing in inventory ahead of time, they're increasing the risk of not matching that supply to demand. So that's kind of what I would say is, stay the course. Don't let this kind of make you take more operating risk because we know how that ended up and it wasn't good in 2019.
So I guess that point then is, can tariffs be managed if the execution and the management team is on it and doing well? Like, is that the real takeaway from tariffs in retail? Not that it's just going to blow out all retail.
So that is exactly correct. If you have a brand that has heat and can be sold at full price, and that is a very small 20%. Most people are playing in commodity world, right? If you don't get it here, you can get it someplace else for cheaper. The fact of the matter is the average apparel retailer has whittled down their China exposure to less than 10%. So we just think about it at 10%. If all you're doing is taking the margin hit, it's about 100 basis points to the P&L. It's really hard to offset that anywhere else through price pass-through or anything else. So the fact of the matter is lower profits, but you don't want to turn that into a multi-quarter or multi-year problem. Mm-hmm. You absorb it this year, and then you rebase, and you grow the business profitably again next year. But those like On, Hoka, UGG, Tapestry, right? If you have hot brand, you can actually pass through some of that to the consumer, and they will take it because there's scarcity.
Adrienne, such a pleasure. One of the best out there. Really appreciate it. Adrienne Yih over at Barclays joining us there. And that's why I think it's so interesting. And you can see it in Kroger's numbers too, for example, right? Like tariffs are going to hurt everybody, but how you execute it and the product will depend on how much hit you're going to take.
Yeah, and I think too, we talk a lot about how a lot of these companies, they obviously had a taste of this about, 5 years ago. So maybe they have better management in place or at least better controls in place to kind of manage some of these inventory
Or if you're
challenges.
Walmart, you just call China and say, hey, I want a discount on my supplies.
Yeah, but
let's roll.
Did you see that story though? Apparently they're not getting the discounts.
They're
getting some pushback.
That's interesting.
Walmart
All right.
can't get it.
All right, who can? All right, we're going to get an update about the cleanup efforts for those tragic California wildfires. It's our conversation with Pedro Pizarro of utility company Edison International, embroiled in the wildfire mess. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Lots of stocks to watch today. One in particular is Edison International. That stock is up by about 2.5%, but it's been a really rough go during those California wildfires. There are some developments in that investigation on what caused those wildfires in Southern California back in January. LA County is suing Edison International to recoup losses from the fire, alleging that its equipment may have caused the blaze. Edison stock took a massive hit at the start of the fires. We spoke to Edison president and CEO earlier about how the company is addressing the matter.
We do see a number of concerning items, including the videos that you've seen out in public. But at that point that is viewed as the likely source of ignition, we're not seeing the typical signs of ignition. We're not seeing the arc marks. We're not seeing the molten metal or the missing metal. And so we are eager to continue to look further. A key next step will be to remove the transmission line. It's an idle, de-energized line. We want to remove that from the tower to inspect that. It may still take us a few more weeks to do that, though, because we are in the middle of negotiating a protocol for how we do that safely and appropriately in concert with a number of the plaintiffs' attorneys and other stakeholders.
So then broaden it out. I'm assuming that if you take a look at that, you're going to have to take a look at all your idle transmission lines and make sure there's no risk going forward. What kind of labor, time intensity, and also maybe CapEx will be involved in that?
Well, Alex, if it ends up being that this idle line was involved, it will not have been through a typical ignition mechanism. And it was at the energized line. It sits next to energized lines. There was no fault on those energized lines. There was a fault somewhere between 5 and 12 miles away on a different set of transmission lines. And so the idea being explored is that somehow that fault led to an increase in current, which then led to induction that would have provided energy to the idle line. So this is, again, not something that is common. If we find that that was indeed the mechanism, A, we want to learn so we can make our system safer, and B, we want to share that with the industry, because I think the entire industry will be safer coming out of that. I don't have an estimate for you yet in terms of what that would mean financially, because we don't even know if this is what happened. But at a minimum, it would entail, thinking about how we do our inspections, how we do our grounding, how we, continue to maintain those idle lines. And again, I want to point out, these are not abandoned lines. They are idle lines that we inspect annually and maintain.
I am curious, Pedro. So as we move forward and we get through the investigation and those inspections and actually start to get down to the rebuilding and compensation, where does that money come from? There's been a lot of talk here about replenishing the wildfire fund and potentially replenishing some of those funds with money out of, effectively, your own shareholders' pockets.
Yeah. So I want to remind folks that in California, we have legislation that was led by Governor Newsom and the legislature in 2019 that frankly is the model for the country around how to work through wildfire mitigation. It does three things. It set wildfire mitigation plans that are overseen by the regulators that define the expectations for utilities in keeping the system safe, and therefore they keep our community safe. Second thing it did was that it recognized that the risk will never be zero. As hard as we work as utilities, as hard as the state works on firefighting, in spite of everybody's efforts, we have extreme weather. We had 100-mile-an-hour hurricane-force winds that prevented firefighters from flying their aircraft during this event. Because the risk will never be zero, the law created a wildfire insurance fund that has a capacity of around $21 billion. And so, Romaine, that's where the funds would come from if this fire is determined to have been linked to Edison equipment. The third thing, by the way, that the fund or that the law did was that it created the right balance between keeping our shareholders, our company accountable, right? While at the same time maintaining the financial health of our utility companies so that we can serve our customers and serve the state. And so just as a reminder, if the company is found to have been linked to the fire, it is presumed to have acted prudently, reasonably, because we have a safety certificate in hand.
Yeah.
If at the end of the process somebody creates serious doubt about that, we will then have to show to the Public Utilities Commission why we believe we were prudent. If we're found to have been imprudent, there is a cap on the exposure to shareholders. It's 20% of our T&D equity rate base. Today, that would be about $4 billion.
Right.
In the future, that might be a bit larger as our rate base grows. So let's say it's $5.5 billion. That's if we're found fully imprudent. The commission might decide that we were partially prudent and assess a lower disallowance.
Yeah.
That's still much lower than our market cap of around $20 billion today. So it's a good balance between enough pain for the shareholder to keep us accountable while preserving the financial health of the utility.
And as you sort of move beyond that, there are some longer term issues that you have to address as well. I mean, there are going to be upgrades one way or the other, whether it's directly related to what happened with the wildfires or really just your own long-term planning. In that process, I am curious about the cost to do that, particularly given some of the shortages we've seen with transformers and some of the other components, and particularly against the backdrop now of what potentially are going to be new tariffs that could further exacerbate that shortage.
Yeah, absolutely. And we're looking at all of that. I do not have an estimate for you today of what rebuilding these areas will entail. Our team is working on that. Team moved very quickly to repower everybody who could receive power. We're now looking at how we rebuild, particularly the most impacted areas. We expect undergrounding will be a larger part of the solution because that's our standard for new developments today. And sadly, areas like Altadena will look a lot like a new development, given that the horrible devastation there. You're right, to the extent that tariffs come into play. We've certainly seen President Trump's policy on that still evolving, but that could put a lot of pressure on the underlying materials.
Do you feel confident you could do pass-through there to your customers? Would you be allowed?
Well, that would be a cost of service, appropriate cost of service that would be passed through to customers. But importantly here, we've done a lot of work over the last decade to mitigate cost increases. If you look over the last 30 years, SCE's rates have increased at around the level of inflation. We went well beyond that over the last 5 years, driven by power market costs, as well as wildfire mitigation costs and the cost of a number of policies in the state. However, we have provided disclosures that between 24 and 2028, even if SCE gets its full request in its general rate case and its full request in a number of other proceedings, we see rate increases at SCE going back to growing at around the level of local inflation, around a 2.6% CAGR, annual increase, compounded annual increase through 2028. And while the devastation in Altadena and in Malibu was significant in the context of our large capital program, which will be around $8 billion a year, I don't expect that that alone will create a significant delta over that 2.6%.
Pedro Pizarro, the president and CEO of the utility Edison International. We caught up with him earlier today, really talking about the effects of those wildfires out in Los Angeles, the potential cost, of course, liability costs for Edison, and of course, the cost to rebuild as well. Coming up here on the program, we're going to take a look at some of the big movers on the day, on the week, and really on the year. And, well, we have to talk about Tesla erasing all of the gains from the Trump bump, and a lot of questions right now about Elon Musk, his role in the administration, and whether that's weighing on Tesla itself. It's our stock of the hour, and it's up next. This is The Close on Bloomberg. Tesla shares remain on the back foot, down 2% today, more than 11% on the week as the EV maker loses some of its, well, really all of its post-election rally due to growing anxiety about its core business of selling cars and, more importantly, well, the core person who's supposed to be running that company. Sarah Frier joins us right now from Bloomberg to talk a little bit more, I guess, what's ailing this stock. I mean, we should point out, I mean, this is pretty dramatic. I mean, we're down 12% this week, and that's on top of 13% the week before, 5% the week before that, so on and so on and so on, Sarah. And a lot of this seems to be because you're starting to see material softness in sales at Tesla, in China, in Europe, and I presume when we start to get more clarity on the U.S. numbers, we're going to see it there as well.
I mean, Tesla is a global company, right? And there was a lot of assumption that when Elon Musk joined the administration in the powerful job that he has, that he would do things in his self-interest. And of course he has. But Tesla doesn't just want to sell cars in the U.S. They want to sell cars globally. It doesn't help that their CEO has been in absentia, just completely focused on Doge for the last few weeks. So, you know, it's a really trying time for Tesla. And it does not surprise me that the stock is back down to these levels. And I do think it could be a stock where we see a lot of volatility to come. A lot of the magic of this stock is tied up with Elon, the person, with Elon Musk and his imagination about how the world may be, his ability to invent the future and promise it. And people have given him a lot of slack, but the fact that he is so tied in with Trump and Trump's successes and failures is definitely a risk to the future of this company, which makes up the bulk of his wealth.
It's like a whole different trading proxy when you're looking at Tesla's stock, right? President Trump said earlier today while signing some executive orders that there is no clash between Elon Musk and his cabinet. Knowing what you do about Elon Musk and how he manages and communicates, what's your best assessment of that?
Well, I think that he's going to give Musk some time to try to make Doge work. There's been a lot of power that Musk has been able to have in the administration. There was a great New York Times story today about what's happening behind the scenes, especially with Trump limiting his power in a cabinet meeting, saying that he's going to use a scalpel, not a hatchet, when it comes to cuts. There is some tension brewing between the president and Musk, if not in the open, then behind the scenes. If you agree with what happened in that Times story, listen, it could rectify itself. Musk is still extremely powerful, extremely forceful in whatever future Trump is building. We could see future swings in this stock, of course.
So, Sarah, I am curious.
But I do think it's difficult to imagine a future where Trump and Musk get along forever.
Well, that's what I'm curious about. Where is his power coming from? Is this sort of self-granted, or is this sort of basically he's serving truly at the pleasure of Trump?
I mean, even if he's serving at the pleasure of Trump, the methods that he is using, the ways that he's going about his business are very Muskian, very in line with exactly what he did when he took over Twitter and turned it into X. It's this slash now, fix later kind of mechanism, which may work in a private company that you've purchased, but this is taxpayer dollars.
All right, Sarah Frier there. We want to go now down to Washington, where the President of the United States is kicking off the very first White House summit on crypto.
I want to thank you for this election. And they just had a presentation in the Oval Office, and I thought this was such a beautiful, this is the trophy. This is a big deal. The World Cup is the biggest sporting event, and Gianni Infantino is my friend for a long time, and during my first term, we worked out a deal to get the World Cup, and then because of lots of interesting things that happened, I ended up being president. When it showed up, I was always disappointed. I wasn't going to make it. I was going to serve 8 straight. Instead, we did it the hard way, but maybe the more important way. So I will be with you as president, Johnny. So maybe you could just say a few words and show how beautiful the World Cup trophy is. Thank you. Yeah, sure, please. Yeah. The famous key. That's a great key. You want to open it, President? Or well, you go ahead. I trust you.
So this is the new trophy of a new competition. It's called the FIFA Club World Cup. The 32 best clubs in the world with the absolutely best players in the world. And for the first time in history, this competition takes place in the United States. Opening game on the 14th of June.
Right.
Obviously, in Miami, final on the 13th of July this year in New York, New Jersey. But it's not that. The trophy is special because it has a key and because, as you can see, if I manage to do that, yes, it's a bit tricky. It's like that. So this is a trophy. It is a trophy which represents, and that's why I think it's interesting to show this trophy exactly in this form, because it represents the past, but it's also projected to the future. There is no other sports trophy which looks like that. It has engraved the history of the game, of soccer or football as we call it, the participating teams of the first edition, the stadiums, beautiful stadiums in 11 cities in the United States of America where this competition will take place. So at the same time, past, present, and projected to the future. And if I may, President, say another 2 words, and then I let you work. I would like to congratulate the President and the administration for not only for the World Cup, the Club World Cup, the World Cup, and the great work done, but also for this initiative that you are speaking about here. If I may add something in this respect, I'm not an expert at all, but FIFA, as you know, is a brand which is globally known, a very strong brand. The soccer economy in the world is worth around 270 billion a year. 70% of that, Mr. President, is in Europe. So imagine the potential that there is around the world only in soccer if we develop it. And so FIFA is very, very interested under my presidency to develop the FIFA coin, to do it from here, from America, and to conquer the 5 billion soccer fans in the world. So if there is anyone here who is interested to team up with FIFA, here we are, together with the United States of America, and we will conquer the world of soccer with the FIFA coin. Thank you very much.
Thank you. That coin, that coin may be worth more than FIFA in the end. It could be quite a coin, actually. Huh? Anyway, thank you, Johnny. Great job. I just thought you should see this trophy because it's really, it's the biggest sporting event in the world, and we have it here. And we appreciate being selected. Thank you very much, Johnny. You do a fantastic job. And welcome to the first ever White House Digital Assets Summit. I know that many of you have been fighting for years for this, and it's an honor to be with you at the White House. I want to thank the White House AI and crypto czar David Sachs, Treasury Secretary. This is David right here, in case you don't know. You know David. And a man who's doing a great job as Secretary of Treasury. Scott Bessent, who's right here. Scott, thank you very much. Commerce Secretary Howard Lutnick, wherever you may be, Howard. Hi, Howard. He's doing some interesting work right now with all that's going on. He's right in the middle of it and doing a great job. Thank you. SBA Administrator Kelly Loeffler. And thank you. SEC Commissioner Hester Pierce. Thank you, Hester. Acting CFTC Chairman Caroline Pham. House Majority Whip Tom Emmer. Hello, hello, Tom. Representative Brian Stile. Thank you. Brian, thank you very much. Digital Assets Council Director Bo Hines. Good, Bo. Great job. And many other distinguished guests. We have a lot of very distinguished people around the table. Some of them will be speaking. I want to thank Marco Rubio also, who's right over there. And we have tremendous people very interested in this subject. And last year, I promised to make America the Bitcoin superpower of the world and the crypto capital of the planet. And we're taking historic action to deliver on that promise, as you know, around the table. Yesterday, I signed an executive order officially creating our strategic Bitcoin reserve. And this will be a virtual Fort Knox for digital gold to be housed within the United States Treasury. That's a big thing, Scott. The federal government is already among the largest holders of Bitcoin, as you know. Really one of the largest holders in the world, with as many as 200,000 Bitcoin obtained via civil law and various other forms of law, and including enforcement actions. These existing holdings will form the foundation of the new reserve. Unfortunately, in recent years, the U.S. government has foolishly sold tens of thousands of additional Bitcoin that were worth billions and billions of dollars had they not sold them, but they did sell them, mostly during the Biden administration. Not a good thing to have done. From this day on, America will follow the rule that every Bitcoin knows very well: never sell your Bitcoin. That's a little phrase that they have. I don't know if that's right or not. Who the hell knows, right? Who knows? Who knows? But so far, it's been right. And well, let's keep it that way. The Treasury and Commerce Departments will also explore new pathways to accumulate additional Bitcoin holdings for the reserve, provided it's done at no cost to the taxpayers. We don't want any cost to the taxpayers. In addition, my order directs federal agencies to conduct an inventory of all crypto assets currently held by the U.S. government and determine how they can be transferred easily to the Treasury. Non-Bitcoin digital assets will be held in a new U.S. digital asset stockpile where they will be managed properly. My administration also is working to end the federal bureaucracy's war on crypto, which was really going on pretty wildly during Biden until the election came about. About 5 months before the election, he became a big fan because he heard how many people were in favor of it and how many people love it and respect it. But I guess it didn't work out too well for him. People understood what was going on and paved the way for groundbreaking innovations in institutional finance. Under the Bitcoin administration, regulators strong-armed banks. I mean, they really did. They strong-armed banks into closing the accounts of crypto businesses and entrepreneurs, effectively blocking some money transfers to and from exchanges, and they weaponized government against the entire industry. But I know that feeling also. Maybe better than you do. All of that will soon be over, and we are ending Operation Choke Point 2.0. Now, some people really suffered. It was ridiculous what they were doing. But in the end, they came around, but they came around for the wrong reasons. They came around only because they wanted votes, and they saw that tens of millions of people were against them because of what they were doing. I also want to express my strong support for the efforts of lawmakers in Congress as they work on bills to provide regulatory certainty for dollar-backed stablecoins and the digital assets market. They're working very hard on that. This is a tremendous opportunity for economic growth and innovation in our financial sector, and will really go a long way. I think it's going to be a tremendous, we feel like pioneers in a way, of tremendous method of growth. And things are very much tied, and we want to keep it that way. The U.S. dollar, long into the future, we're going to keep it that way. I hope lawmakers will send that legislation to my desk before August recess if they can. And they're very much working with you, and you know a lot of them, and a lot of them were committed right from the very beginning. So I just want to congratulate you all for being at the White House today, and a man who knows more about Bitcoin and AI.
And we're listening to President Donald Trump at the White House holding the first White House summit on digital assets. The president a little bit earlier signing off on an executive order that ostensibly will create a Bitcoin reserve, or a crypto reserve, I should say, here in the United States. You can continue listening to the president's comments and, of course, the crypto advisor there, David Sachs, to his left, by typing in LiveGo on your Bloomberg terminal. Now, as they speak, and as all those folks in the room try to work out sort of what this new crypto summit will be, and more importantly, to try to work out what this new reserve will look like. We want to bring Noelle Acheson into the conversation. She's the author of the Crypto is Macro Now newsletter. And Noelle, there's been a lot of discussion about exactly how they would do this, whether they would be bringing in new assets or basically taking what was already on the books and using that to effectively start this. When you look at the contours of what we learned so far today, is it what you expected?
It's not what I expected at all, to be honest, Romaine. I did not expect an announcement last night before the crypto summit today. And to be honest, I didn't expect them to come up with such a masterful compromise between the various competing camps within the crypto ecosystem. I confess I belong to the camp that did not think a strategic Bitcoin reserve was a good idea because, in my view, a large deficit nation should not be using public funds to acquire an alternative asset. I also did not get the argument that it would strengthen the dollar. The dollar needs strengthening. It was a strange message to put out. But what they come up with instead, I should say that a stockpile is a totally different story. We're all behind the idea of a stockpile in which the US government commits to not selling what it already has. What they came up with was both. You have a stockpile with all the crypto assets that's currently in possession of the US government. Bitcoin gets special treatment. The Bitcoin already in the US government's power is wrapped into a grown-up wrapper. It's a stockpile, but with a very grown-up veneer. And this also includes the commitment to study ways to acquire more without the commitment to actually acquire more. In other words, something for everyone.
Noelle, where's the funding that comes from this? So in the oil market for the Strategic Petroleum Reserve, you have to go to Congress to get approval to get money, then go buy oil. What's it going to be like here? Do we know?
We don't know. Budget neutral. That's what we know. What does that mean? That obviously means no direct cost to the taxpayer, as President Trump was just saying. It also means that they don't need to go to Congress for approval of this, which is just as well because no way would they get congressional approval for using public funds to acquire crypto assets. What will this look like? Maybe revaluing some gold certificates, maybe selling some of the cheese reserve. To be honest, I don't know. But we do know that it's not going to be as much as originally hoped. That's one of the reasons we're seeing some disappointment in crypto today, but it will be measured. It will be positive if indeed they do accumulate some. It sends a very loud message to the world, but it won't be enough to destabilize either confidence in the dollar or confidence in the Bitcoin network.
Noelle, really appreciate you taking time for us. Noelle Acheson there, author of the Crypto is Macro Now newsletter as that White House Digital Summit continues. The President of the United States there, of course, continuing here with those announcements. Meanwhile, Alex, we are getting closer to those closing bells. A nice little rebound here on the day, but not enough to wipe out the losses for the week.
Nope, you're still looking at the S&P down about 3% on the week. This would be 3 straight weeks lower for the S&P. Lowest level hit this week since November of 2024.
You're looking at an S&P higher on the day by roughly about 0.5%. We'll call it 0.6% as we wait for these numbers to settle. The Dow Jones Industrial Average up about 0.5%. The Nasdaq up about 0.7%. But across the board, they are in the red on the week. Down 3% here for the S&P, Nasdaq, and the Dow down about 2% on the week. Alex, the Russell 2000 lower by 4%.
All right, well, let's get you set up for how to position for next week. I mean, a lot can change in a few hours. Ayako Yoshioka, a portfolio consulting director at Wealth Enhancement, joins us. Now, Ayako, how do you manage this volatility? What's on sale? What do you avoid?
Sure. So much uncertainty out there. And, I think one of the things we've seen all this momentum come out of the market. And so I think the things you want to avoid is the things that have the most downside momentum here. And then, the value stocks that are out there, things that in those value sectors, I think is where you want to pick up some exposure.
What is value now?
We've definitely seen, I think those value sectors in financials, in energy, in industrials, a lot of the more cyclical areas, which again are, in a catch-22 a little bit, just because there's this overarching feeling that the economy is slowing down, so you don't necessarily want to be too exposed there, but you do have some good quality names within there. Even within financials, the banks are still doing okay. They're not as exposed to tariffs, so JP Morgan, Visa, MasterCard, those are great names to be in.
Is there sort of a sense, though, that you can be comfortable with the chaos? Meaning, we're all sort of stressing out about what tariff policy and other Washington policies are going to mean for the economy. so far, and we heard this from Jay Powell today, this hasn't really shown up in the hard data. It might at some point. But is there a sort of a case to be made to sort of keep investors and keep your clients sort of steady as she goes, that maybe over the long term, this all works out?
Sure, and I think this is some of the conversations we were having at the end of the year, last year, when we're at back-to-back 20% plus years. You can't expect another 20% year. So we knew that we were going to enter a time period with a little bit of volatility, and we weren't expecting things to continue to the moon. And so everybody's rebalanced their portfolios, again, taking some more exposure to bonds, which has been a positive for a lot of our clients.
Yeah, is fixed income still, I mean, is it popular now? Because, I mean, we talk about, obviously, there's been a lot less movement in that space. I understand that if you do want to lock in, 4.5% or something, you can do that. But there are a lot of people that look at public assets, public equities, I should say, and they also look at private assets and say, well, I can make multiples of that with only maybe a slight increase in risk.
Absolutely. I think alternatives and private assets in general have definitely entered the conversation. And you're taking a little bit away from both public equities as well as public fixed income in order to balance that out. It's the volatility dampener within the portfolio for many of our clients.
Do you like Bitcoin or crypto, speaking of?
We personally don't have a position in any Bitcoin or crypto markets, but we do have clients that have Bitcoin ETFs and exposure there.
When you look at policies from the Trump administration, there is a narrative out there that Trump is trying to move government spending away from the government and to the private sector. And we heard Scott Bessent earlier today talking, Treasury Secretary, that there'll be a detox period where you got to kind of shift where that's coming from. Do you guys buy that? And if you do, kind of what is the thinking? Extrapolate the thinking on that.
Absolutely. I think all of the uncertainty regarding tariffs and everything else, that just enters a lot of uncertainty for business owners, right? Decision making is very difficult. And so I think that halts a lot of activity, which is what everybody's concerned about when it comes to that moderating economic growth. And so I do think some of that's going to happen. Maybe they're trying to force the Fed's hand in terms of trying to reduce interest rates because the economy is slowing. And markets are reflecting that. We're seeing more cuts expected in 2025.
Are you getting questions from clients about international exposure to international stocks and international assets?
Yeah, absolutely. Valuations were at a 3 standard deviation differential at the end of last year. And, international stocks have been cheap for a very, very long time, and they haven't worked. And they're finally starting to work. For now. And a lot of that has to do with the weakening U.S. dollar, right? And a lot of the things that are going on with the interest rate differentials. And so, we will have to see. But yeah.
And we haven't had a chance to go through all the superlatives, but I was looking at the dollar earlier. I mean, this is the worst week we've seen for the dollar, or at least the basket versus this basket of peers since 2022. And that's significant. That's going to have huge implications, not only for how you value equities, but also for the bottom lines of some of these companies.
Absolutely. Yeah. And, we have to worry a little bit about that carry trade that, scared everybody back in August of last year. And, we've seen some inflation in Japan sort of start to rise. And, we'll have to just wait and see.
All right, Ayako, I really appreciate you taking time for us. And thanks for being patient as we work through this day here and we work through what has been an incredibly volatile day and an incredibly volatile market. Alex, the day is over, but the idea that you did see people come in on a Friday willing to buy the dip in some of these names here, I don't know, does that encourage you?
No. But I'm usually pessimistic anyway, so I'm like let's put gold under my bed. But we did see retail come in on Wednesday and buy the dip, but we are seeing funds kind of flush out a little bit. So I honestly don't know where that leaves us for Monday.
All right. Well, on that optimistic note, Alex Seal, we're going to say goodbye to you. Alex is gone for the weekend. Scarlett Fu stepping into Studio 2 in just a moment, where she's going to set us up here for a celebration of International Women's Day. We've got an all-female hour coming up, a power hour coming up in just a second here. Stick around. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A volatile end to a volatile week. Fortunately for some folks, it actually did end on an up note. On the day, stocks were in the green across the board, but on a weekly basis, that was not enough to overcome the big losses that we saw earlier in the week. Down about 3% on the S&P 500. Similar declines for the NASDAQ. 2% lower on a weekly basis for the Dow Jones Industrial Average and 4% lower for the Russell 2000. A big part of the drag, of course, came from big tech. The Magnificent Seven as a group down 4.5% here. And we should point out, as a group now deep into correction territory. The KBW Bank Index financials, it had been a big bright spot over the past few weeks. The bloom came off the rose in a big way as a group, down 9% on the week. And if you are looking for a bright spot, well, you can find it in the healthcare space. Doesn't look like much, Scarlett, but at 0.2%, I'll take that over a 3% loss.
Absolutely. Holding steady is a new up right now. All right, let's take a look at some of the day's big movers. And I picked Costco because it's really emblematic of some of the issues that companies are facing. Falling the most in 1 year, down 6.1%. This is not typically a stock that falls that much. The warehouse retailer reported a rare miss in quarterly profit due to higher supply chain costs. The last time that Costco's earnings per share missed analyst estimates was back in December of 2022. So again, not all that common. Walgreens Boots Alliance, one of the big gainers of the session, up almost 8% on the day. The drugstore chain is being taken private by Sycamore Partners for $10 billion. Sycamore will pay $11.45 a share in cash. That works out to about an 8% premium to Walgreens close on Thursday. Now, beyond the bell, we have got an all-female power hour coming up for you, starting with the CEOs from the cosmetics and hair care industry, Glossier's Kyle Leahy, Huda Kattan of Huda Beauty, and Amanda Baldwin of Olaplex. And then after that, a focus on investing, legal advocacy, and branding with Emily Green of Ellevest, Carol Moody of Legal Momentum, and Jenna Lyons, the former president of J.Crew. Romaine?
All right, well, let's dive right into it because our first guest knows a thing or two about branding. Kyle Leahy is the CEO of Glossier, and she joins us here in studio too. Kyle, great to have you here.
Nice to have you. Thanks for having me.
Obviously, this is a killer brand, and I think it's like the brand that I think when people think of sort of the new world order, if you will, how to create a brand and how to grow it, a lot of people point to the early success of Glossier as being a template for a lot of the other brands I've and I'm not just talking about in the beauty business. I am curious, can someone replicate what Glossier did now?
Well, Glossier certainly is a once-in-a-generation brand, transcendent of beauty. We've now celebrated our 10th year, so shown incredible longevity and resilience for the brand. It is a multi-generational, multi-category brand. And I think what really sets us apart is how our brand connects so deeply on an emotional level, a values-based level, with our consumer and our community. It's a brand that was built a decade ago by our founder, Emily Weiss, to really celebrate women, celebrate community, celebrate beauty in everyday life. And we continue to bring that to life in a way that I think is truly differentiated. Yet we have all the tenets of brands that last for decades and being multi-generational, being multi-category, and continuing to thrive and grow.
How do you sell beauty these days? Because I feel like in the old days it was all, okay, just find, the supermodel or the celebrity, actor, whoever, or athlete to show you, putting whatever on his or her face, and then we all go out and buy it. That doesn't necessarily work the same way today, does it?
For us, our brand is all about the community, and it has been built. We are not a celebrity-driven brand. There is not one face. It is about the collective. It is quite literally about you. It is about the notion of you look good, which is about beauty should be about how you feel and having joy and confidence in beauty in everyday life. And then we've evolved our strategy to really help build a brand and now a business that's thriving, that really brings that beauty brand to life across where people shop for beauty. So we've activated an omni-channel strategy that really brings our brand to life, not just through our powerful digital channel, but now through our stores and our partnership with Sephora. And we're excited about what that means for the future.
I'm so glad you brought up You because, of course, Glossier You was the story in summer of 2022 after Abigail Warner's TikTok video showed how quickly you guys were able to mobilize and respond to the demand and meet the moment. I'm sure other companies took notice as well. What did you learn from how you were able to respond and how that sets you apart?
Yeah, so Glossier You is our iconic fragrance. It's a skin scent enhancer. It smells a little different on everyone. Quite literally, you are the final ingredient. It is our top seller, and fragrance is actually our largest category. One of the key differentiators for us is that we are a multi-category brand and multi-category platform. And it began in 2017, so it's a fragrance that actually has been building over the last 8 years. And to your point, in 2022, it went viral with a wonderful organic video from Bitcoin Poppy that really created a viral moment. But really critically, that was not just a flash in the pan. It really built something that continued to build now for the next now 3 years. We seized that opportunity on TikTok. We amplified that content. That content beget more content across our community. And then a year later, we launched in Sephora. It was the #1 fragrance in Sephora, continues to be the top fragrance in Sephora. And so we see this build of momentum where our fragrance is now 5 times the size it was at that moment and continues to have incredible growth across our business.
So what I find really interesting about that is that you were able to move on it right away and kind of deliver what people wanted to see. You amped up production to meet the moment. Do you think supply chains are nimble enough now in this current Trump tariff haze to respond in a similar way?
I think you have to have a company that's nimble. We say often that we move at the speed of culture. We are 10 years old and we're proud that we are now the next modern legacy beauty brand, but we're also still entrepreneurial. We're highly agile, we're highly nimble, we're digitally native. So that's built into the ethos, and we continue to keep that scrappy nimbleness part of our culture and the way that we can drive results and really be reactive. So we were in position to do that. I think the supply chain environment continues to be very dynamic, very volatile, but when we have a solid supply chain as we do, and one that you can be reactive, and a culture and processes that enable you to drive growth when you need to, we're in position to win in that way.
Have you seen any disruptions at all in terms of being able to get the supplies that you need?
Not at this point.
What about labor costs?
Not at this point.
Not at this point, really?
Yeah.
Okay.
So, consumers in general have turned more cautious in 2025 as the constant threat of tariffs takes its toll and also raises people's inflation expectations. I'm sure there have been subtle changes to consumer behavior. What are you seeing now versus, say, before November? Just, it may not manifest in sales, but it certainly manifests in terms of, just browsing on your website or, physically your products at stores.
Yeah, I think we're certainly operating in a highly, goes without saying, a highly dynamic environment. And I think the consumer is feeling that. It's been a very volatile year. Obviously, everything that's happening geopolitically, everything that's happening, whether it's the fires in LA to in the consumer landscape, questions about TikTok to, and I think that weighs on consumers. I think people are feeling that. I think that dynamism is challenging for both customers, but also for employees. And I think they're looking for brands that offer hope, that offer strength, that offer resilience, that offer values. And I think our brand stands for those things and continues to be a source of joy and continues to be a source of comfort, continues to be a place where you can find those moments not only in your beauty routine. And so we will continue to bring those things to life. I'm proud that Glossier, we're at our record high revenue levels, record profitability. And so we continue to see momentum that continues to outpace in the marketplace.
Is there a sense, though, and this kind of gets to Scarlett's point, too, this idea that in some cases, beauty products and just, body care tends to be a little bit more recession-proof, that even when times are bad, people still spend money on that. And in some cases, maybe even spend more because, they need that comfort that, at least I can take care of myself if I can't necessarily take care of the rest of the world.
Invest in your face, right?
Yeah.
Beauty is an incredibly resilient category, and we see that through highs and lows, that the brand is very resilient. Our brand is resilient, and the category is resilient. Our price point is really unique in that we represent what we often call an everyday luxury. So you can have those moments of joy and have those moments of elation, but be able to do that in a way that's very accessible. And because we offer fragrance, skincare, makeup, body, merch, we very much operate like a lifestyle brand in beauty, which gives us the diversification to play into different aspects of the business cycles and gives us an incredible platform, not just for growth, but for managing risk.
You mentioned very quickly you're a non-celebrity driven cosmetics brand, but you've broken through. I'm curious whether any celebrities or influencers have pitched themselves to you.
We do have a wonderful community. One of the things we're proud of is all the people that we feature, whether they're in our campaigns or our partnerships, whether it's a partnership with the WNBA, where we were the first beauty brand in 2020 to really lead, I think, in that way. So for us, it is about the community. Is it about the people-powered ecosystem, our all-female leadership team, to the team that we're building in our employees, to the people that are featured in our campaigns, to all of our community that is part of building and changing how the world sees beauty, which is truly our mission.
Kyle Leahy is CEO of Glossier. Thank you so much.
Thank you.
From one major beauty CEO to another, Huda Kattan is CEO of Huda Beauty, and she recently joined us to discuss how she grew from a beauty blogger and makeup artist into being the CEO of an internationally sold beauty empire. Take a listen.
The barriers to entry are definitely lower. You can go viral now pretty easily. When I think back to when we launched, I had to beg Sephora US for years before they would take us. And so the concept of an influencer brand at that time wasn't really a thing. But today's world, it's a thing. Like, and actually, in fact, retailers are looking for the next hot brand that will drive more traffic to their stores. So I definitely think the barriers to entry are lower. However, the competition is definitely much higher. And then the need to constantly create new ideas, more creative ideas, is definitely harder. People's attention span is lower than ever before. So the challenges are definitely different than they were, 10, 12 years ago when I first started.
Huda, you studied finance at University of Michigan, and you made clear that you never wanted to go into banking after graduation. And in fact, you would have preferred studying marketing. Having said all of that, how did that background, that finance background, help you build out your business, especially as you were the first influencer to get private equity backing?
I mean, it definitely, I think, gave me some understandings. I think the best thing that came from me going to university and studying was actually being involved in student activities and, leading some of these student activities. So, I was the president of one that was really engaging in the business department in the school. That actually completely shaped me. Sure, finance, understanding P&L, all those things are really, really great. And I I grasp these things really quickly when we're going through them. But I definitely have a natural aptitude towards marketing and the psychology within marketing. And so I definitely prefer this. And I think when social media hit, I was like, whoa, this is so interesting. Because now you have a way to hit so many people. You have a way to create tribes and communities and like a sense of belonging for so many people. And nowadays, in today's age, I see that people need that sense of community and belonging more than ever. And that's definitely something that we are always trying to create with our community.
Yeah. Well, the finance, though, that background has to come in handy now when we talk about valuations, at least if you believe public reports, over $1 billion for the company right now. You just had that deal selling the stake in the perfume business, and Bloomberg reported last month that you were looking to buy back the stake that TSG had taken back in 2017. You can't just do that with marketing chops.
I'll actually tell you this. This is like an exclusive. I haven't actually shared this with anyone. We are now buying back our shares, and I believe we are one of the only, if not the only, now private beauty companies in the space, which is pretty, we're very excited about that. But yeah, sure. I mean, I have to have some understanding of finance and just business in general. Mm-hmm. I will say it's not traditional understanding. And that's also what's been very cool about the social space. If you can create things in a way that you just could not do that just 10, 15 years ago.
And we could be headed for some economic softness, if you will. And there's always a big discussion during economic downturns as to whether beauty products are discretionary or, for a lot of people, essential products. And I am curious as to how you chart your path forward as a business, having to now start to go through different economic cycles. So not just all on the up, but also dealing with the down.
And one of the first things that I did when I did become CEO was focus on our hero strategy. And in today's world, it's something that we're really bolstering down on. And it's something that I believe in. You don't need to have every single product. Mm-hmm. And in today's economic situation, you need to have even less product, but be very, very good at what you do. It's a simple philosophy. Don't launch everything, but be very good at what you're known for.
Huda Kattan there, the CEO of Huda Beauty. And Scarlett, I was really impressed with her. This is the first time I ever had a chance to talk to her, because we talk about kind of how some of these beauty brands really now can just come out of nowhere. And you talk about somebody like her, just a makeup artist, a blogger, and then starting selling eyelashes, and then just kind of turn that into selling everything related to your face and your skin. Now almost basically $1 billion brand, depending on whose valuation you want to believe. That's remarkable, Scarlett.
It is remarkable.
It's more than I've done with my life.
Well, we all look like underachievers compared to Huda Kattan. Yeah. But this idea also that it kind of all grew organically, right? I mean, Kim Kardashian was a client, and it kind of blew up with that. And she hit everything at the right time. Yeah. She was an early YouTuber and really kind of figured out how to use the platform to her own advantage.
Well, speaking of timing, another brand that had really gotten a nice upswing was Olaplex. Remember, that was a few years ago. Yeah. It was all of the rage. The company has run into some issues with regards to growth, and it has had some recent changes in management. But just a couple of weeks ago, the company making a big reset here, laying out its plan for the future here as it tries to reset. and that is, of course, under the tutelage of its CEO, Amanda Baldwin, who I'm pleased to say joins us right now. Amanda, great to have you here on the program. I was taking a look at that big announcement you guys made back towards the end of February, sort of a reset and a refocus here as you try to get growth back on track. And I am curious because for a lot of us, Olaplex seemed to come out of nowhere. And then it was all the rage. That was all anybody wanted to talk about. And then it ran into a few issues here. How do you get back that mojo? How do you get this name back into the zeitgeist?
Thank you for having me today. I really think that one's path forward is rooted in your origin story. And as I joined the team about a year ago, I really spent a lot of time learning about two things in particular. One, our science, our lab. Truly, Olaplex products are rooted in an incredible technical foundation. And I spent a lot of time with the pro, the hairstylist, and we have incredible science, but that science becomes real in the chair. And really the source of all the inspiration, everything that we revealed a couple of weeks ago came from those two places. And I think it's really that intersection of science and style that makes Olaplex so special. And that's really what we're going to be building on going forward.
Have you guys addressed, though, some of the criticisms about that science, whether that science or at least the way it was being marketed was sound?
Absolutely. I think that it's so important that we have the most powerful and most strong and safe product possible, and something that I spent a lot of time on. And I think really going forward will be really critical for us to explain our science, to really help people understand what Olaplex does to stand apart, and how they can have the best healthy hair routine possible.
And that's part of the whole reset effort. When you first joined the company, Amanda, it was struggling. Sales were down by double digits. You've narrowed that to a low single-digit decline. At the time when you joined, you chalked it up to increasing competition, growing too quickly, some execution errors as well. Where are you in this turnaround effort? Would you say you're in the 5th inning, in the 8th inning?
I think we've made incredible progress. I'm about 1 year into the role. We really are a different company today than we were a year ago. We have a very clear sense of where we are going to go going forward. We have a brand new brand identity. We've stood up an innovation engine. I'm actually speaking to you from our Olaplex lab right now, so needed to be here today. And we really have a path forward, and we have a full leadership team. That was one of the things that was most important to me as I came into the role, was you don't do this alone in my shoes. And so you really needed to make sure we had the right people. And I'm very proud of how far we've come in the year. We have a very meaningful year ahead.
And we're showing a chart here that shows net sales by channel. Professional makes up about a third, specialty retail about a third, and DTC is a third as well. Talk a little bit more about the goal of tapping into professional customers, the salons and the hairstylists. What kind of investment does that involve? Does it involve more product development or just more variety of sizes of available product? Is it more education?
I'm so glad that you asked about the pro, because they really are the heart and the soul, the muse, the inspiration for everything that we do. And one of the things that I've just absolutely fallen in love with as I've taken on this role, I'm new to the hair industry, but been in beauty for 20 years, is the power of the hairstylist. And one of the things that I think we really can do at Olaplex is do more for them. And I think that does begin with product. Everything that we do begins with product. That's how Olaplex started, was with number 1 and number 2, and really changing the ability of colorists to pursue their craft. We've done that again last fall with Bond Shaper Rebuilding Treatment, in which we were, again, coming back to them with a brand new technical solution to address curly hair, which has its own amazing uniqueness to how it is actually comes out of the head and needs to be treated. And we'll do more of that, right? So we actually announced that we have a new scalp longevity product last week, again with our new rebranding, and we'll bring a pro service to them as well. So we're really always going to be thinking about what can we do for the pro from a product point of view. Mm-hmm. The other two things that you mentioned are also very important to us. Education, right? How do I, as a hairstylist, I have the opportunity to understand product that I use on the client, but also to explain to them what they might use at home. And so that education is incredibly important to us and a big new initiative for us. And last but not least is community. It's just a wonderful group of people. I've really enjoyed that. I think we can do a lot more to bring them together. Mm-hmm. One of the things that we did last June was start a program called Celebration of the Stylist. And that instead of having a 10-year anniversary party for ourselves, we had one for our pros, because we think that that's really the reason that we exist.
Amanda, thank you so much for joining us today. Amanda Baldwin is CEO of Olaplex. And Romain, what was consistent from those voices that we just heard was this idea of community, which is one way of putting it. But I mean, I think of it in terms of like brand awareness through word of mouth, through trusted people.
And this goes way beyond beauty products. You're seeing this everywhere now. It's just that's what sells. It's not just, again, putting that athlete or that actress out there.
The flashy advertisements don't work.
It doesn't work on me, Scarlett.
Very little works on you, actually, when it comes to advertising.
Why not? How does my skin look?
Emily Green, head of private wealth at Ellevest, will be joining us next. This is The Close on Bloomberg.
Women have often been at the front lines for social and political change, but they're also leading the charge for economic change as well. And that includes, of course, the personal finance platform Ellevest. It calls the great wealth transfer is upon us here. And one of the folks helping to facilitate that is Emily Green. She's the head of private wealth over at Ellevest, and she joins us right now. And Emily, I am curious, when we talk about what Ellevest platform is, but more importantly, some of the longer term trends that we've seen to make sure that women have much more control and say over their, not just their own personal finances, but their family's finances as a whole, for those women that are in relationships. Is there a sense here that the progress that's been made toward that has been meaningful so far?
Yeah, so actually McKinsey came out with a report in 2020, so 5 years ago now, about what women actually want in wealth management. And the premise of the piece was actually that women were the next wave of growth in wealth management. They went through a number of ways that women actually think about that. And I think there's been some progress made within this. At Ellevest, we certainly focus on this a lot. Women require more advice. They actually are willing to pay more for a financial advisor who's going to give them that advice. The problem with that actually is going to be that there's a recent study now that there's going to be an advisor shortage, at 100,000 advisor shortage by 2034. And so when you look at numbers like that, that means we're actually going to go backwards, because women are actually going to be able to find those advisors who are going to give them that advice.
Yeah.
And on the flip side, we have seen more wealth management firms, registered investment advisors, move the focus to goals-based investing, which is what we've really seen women think about. How do I get to those transitions? How do I do them, figure out those big life milestones, and how do I achieve those? And we're seeing that that's really the big trend versus focusing on stock picking conversations.
Well, that's interesting you say that too. And then it's interesting too when you talk about the potential shortage of advisors. What about the gender breakdown of advisors? I would assume that a lot of the people, and we should point out, Ellevest, obviously women owned and primarily women run. I am curious, when women are looking for that financial advice, do they prefer to get that from a woman advisor?
We see that, yes. I actually think that's more due to not that they're specifically looking for a woman and someone who's just like them, that they're looking for someone who has the same life experiences as them. And so when they're going to an advisor, they want someone who's going to understand the issues that they're dealing with, thinking through the fact that their salaries peak earlier in their lives. I've had many conversations with women about being the sandwich generation. And so, I'm taking care of my parents and paying for that while having kids, while trying to have this high-paying, demanding job within here, and thinking about what that means. Mm-hmm. And so, I do think that we are seeing more within this space, but a lot more to go.
So women have very specific needs that are different from male investors. Can those needs be solved by model portfolios designed for women, or does it require a more customized approach?
So at Ellevest, we had built when we launched the digital investment advisory 10 years ago, we were really at the forefront of looking at a woman's life expectancy salary curve when their salaries peak. I think that the industry has come a long way within that. We were really the first ones to do that. There used to just kind of be a life expectancy that they expected for everyone. Mm-hmm. And the same with the financial planning tools. I see now that people actually think about these things, and we really are moving forward in that space in terms of this. And so, it does mean that there needs to be differences that can be tweaked within there, but I do think that the industry has moved forward on that.
And going from the long term to the short term, Emily, I'm just curious as to how the week has been so far, because you mentioned how women want to talk to advisors, and I'm not saying they need more reassurance, but they want to speak with someone and get more personalized attention when making investment decisions. In a week or in a period like the one that we have right now, where there's a lot of uncertainty, a lot of headlines that often seem to contradict each other, what is that like on the advisory front for you?
Yeah, I think it's really interesting because the assumption is a lot of times that women are more emotional and therefore they will make more emotional decisions with their money. The data actually shows you the opposite. Women are actually less emotional with their money in making decisions. And I've been at Ellevest for about 7.5 years now, and I've dealt with a lot of market turbulence over that period of time, and really seen how clients have acted versus I used to work at a big bank and most of my clients were male. Mm-hmm. And so I've really gotten to see what that difference is. And it's really interesting because, even in 2020, 2022, we've found that our clients, they want to make sure that they can still achieve those life goals, any transitions in their life, things like that. Yeah. But it's less reactionary of I need to pull out of the market. And even, I do find that this past week has been slightly different because I think that the emotions are actually politically charged emotions that then translate themselves into the market. And I found that to be a little different. I think people are projecting political emotions on the market. But I actually do find that women, our clients especially, have tended to stay the course.
All right. Emily Green, really appreciate your joining us today. Emily is head of private wealth at Ellevest. And we mentioned the market turbulence driven by policy changes. One policy change that's causing division across the country is where organizations stand on DEI. The White House has vowed to withhold federal funding for those who champion diversity, equity, and inclusion. Legal Momentum, the Women's Legal Defense and Education Fund, is directly affected. I want to welcome now Carol Moody, president and CEO of the nonprofit, whose mission is to improve economic outcomes for women across the country. Carol, great to see you.
Good to be here.
So what is the single most important way that your organization's work has changed since the election and since Trump taking office? He's upending the entire federal government, as we know.
Education and defending the laws that we have. People keep forgetting that the laws have not changed. I can say it like 50 times. Title VII of the Civil Rights Act still exists. It is the law. Mm-hmm. And so that's what we've been focusing on because there's so much misinformation out there that people don't know where to turn. We have resources. We can help. So that has really, it's called the Women's Legal Defense and Education Fund, but education is with a big E right now, like a giant E. And the other thing we're focusing on is state laws. States have lots of ability to pass laws and quickly. Mm-hmm. And so we have a federal legislative agenda and the state, we put the federal legislative agenda right here, and the state agenda very, very robust, very, very robust, and we got to get a lot of things done. Unfortunately, the other part, defense, we're defending. Mm-hmm. You say, do I pay attention to the federal agenda? I do, but I pay attention to making sure we keep the laws that we already have. Yeah. There are a lot of protections, and we need to defend those. So that's what we're really focused on, is education, defending the rights, and advocating for rights in states where we can get something done.
So you clearly have your work cut out for you. I mentioned the freezing of federal funds. It affects you in a number of ways. You're a nonprofit, so just that alone. And then specifically because you serve women, that's part of your mission statement. What is the impact on women's economic and physical safety when you don't get as much funding?
It's devastating, and I'm glad you added economic and physical because they are so intertwined. The jobs report came out today. The number one thing, the number one reason why, women don't leave their abusers, domestic abuse, economic insecurity. Where are they going to go? So what happens now is that people don't know where to go. I have to focus that. We have a helpline that's 50 states. People call from all over the country, and they're afraid. That's the biggest problem. They are so afraid. People are afraid that they think the government is now listening to our phone.
Yeah.
They actually are thinking that, I know I'm calling the helpline, but suppose somebody's listening and they hear my name. What are they going to do to me? I can help them, but they're afraid to actually call us now.
Yeah, I'm curious though too. I understand that we have laws on the books that are supposed to offer these protections. Mm-hmm. Those laws are under assault.
Yes.
And we're only a few weeks into this administration, and they've made clear that there are certain laws, including Title VII, which you mentioned,
Yes.
they are gunning for. I'm not sure you're going to solve that necessarily in the courts. Are you going to solve that by lobbying Congress and trying to preserve the laws that are on the books?
We're gonna do both.
Okay.
We are going to go to the courts.
Yeah.
I mean, that's our defense. I mean,
Yeah.
we're lawyers, but yes, we do a lot of lobbying. I think every single day we are asked to sign on to. I mean, there are lots of organizations, and we send letters out to people saying, "Call your congressman. This is what you need to do. Here's a script. This is what you need to say."
Yeah.
You know, so they're not just going, "Help."
How much help are you getting? Is your organization getting? Is there alignment out there amongst what you do, as well as some of the other groups out there that are doing either things similar or at least adjacent? Is there an alignment, or is everyone just kind of out on their own right now?
No, there's a lot of alignment. There really is,
Yeah.
because it's so basic. It's so basic. We are fortunate in that, we don't get a lot of federal funding, although, of course, we had a grant that went in, and then the day everything stopped, but that's beside the point.
Yeah.
But people are aligned. I mean, we have so many coalitions, because this is a hard fight. You pointed it out.
Yeah.
This is going to be a hard fight. They've already told us what they're going to do.
Yes.
And if we don't get ourselves together, this is not a fight that one organization can do. We are aligned. We have coalitions every single day. It's a lengthy call. Okay, this is what you need to do.
This is a dumb question. It's the final question. But do you have faith in the law right now?
I have to have hope.
Okay.
That's what I'll say.
All right.
I have to have hope, because that's what we need. And our tagline is, the best way to protect women and girls is through the law.
All right, well, that's a great way to end it. Carol, really appreciate you being here today. Carol Moody is the president and CEO of Legal Momentum. Scarlett?
All right, well, turbulence is a good way of describing the market action this week and just today as well. The jobs report didn't really move the market. Powell provided some relief because he largely stayed on message, saying the economy is fine and the Fed is in wait-and-see mode. That was good enough, at least for today, to finish with a 0.5% gain. But for the week, it was down, down, down.
And I think the weekly numbers, I mean, we can't really understate or overstate, I should say, just how bad it was. Because we talk about a broad-based sell-off, and I know we got the dip buyers coming in today, but 0.6% ain't enough to get us there. And the question is, do you have enough confidence to get back into this market on Monday and beyond, knowing that the tariff conversation has just basically been kicked down the road for another month? So it's not resolved. It's just, a 1-month reprieve. So I don't know. Maybe they go away. Maybe they don't.
I think everyone's taking it day by day and data point by data point. In the meantime, they're going to things like packaged food companies with, Campbell's company, for instance, doing really well. So go with what you know, the safe haven plays. This is The Close on Bloomberg.
All right, it's no secret that traditional media brands have been losing power to, their streaming offspring, but they're also losing ground to the creator-led economy, like the ones found on TikTok, like the ones found on YouTube, and we had a chance to catch up with someone right at the center of that. Ty Randolph is the former CEO of Heartbeat and is currently the interim CEO of Rock the Bells, and she had a lot to say on this topic.
What's happening right now is very akin to what streaming did to entertainment about 10 years ago, right? Where that was really a disruption in direct-to-audience distribution. What we're seeing right now is a very different empowerment of creators who are able now, because of advances in AI, to do things at the levels that studios could, right? Costs of production are going down. We're accelerating timelines in the go-to-market. But there's a lot of fear and trepidation in the marketplace about what does that mean for the creative community, right? Are they going to be disintermediated from their audiences? Are they themselves going to be completely disintermediated from the business? So there are a couple of things. So you have this real rise that's happening with creator empowerment, and now there's this big accessibility, right? There's more personalization and control, and that is big for studios and for even distributors. But then you have this, real battle from an IP and ownership perspective that's akin to a Napster-like moment in the music industry, where we're really having to redefine what monetization looks like, how contracts are done around NIL, IP, voice, and rights. And so there's a huge advantage, and usually on the other side of that is huge disruption, and we're all really navigating it together.
That was some of our conversation with Ty Randolph, former CEO of Heartbeat. Now, whether it's media or really any other industry that's consumer-facing, branding is all important. It's a crucial tool that helps companies grow their business. Joining us now is an expert in this field. Jenna Lyons is a partner at Fundamentalco, where she helps companies transform and use their brand to their advantage. And of course, you may also remember Jenna as the former president of J.Crew. Great to have you back on.
Thank you so much for having me.
So the backstory here for Fundamentalco is that it was spun off from Blackstone by Johnny Bauer, who shaped the identity of many of Blackstone's portfolio companies.
Correct.
And in fact, Blackstone is a client of Fundamentalco.
Yes.
Compare and contrast the importance of branding for companies that serve the consumer first, as well as companies that serve other businesses, B2B companies?
I think it's a good question. I think one of the things that we see when you have a company that's actually B2B, they already are established in their area. And when you're thinking about where are we going in the future, everything is changing. And as the world is thinking about ahead of time, it's very important to think what's your organizing idea and how does brand connect to that, so that when you're thinking about where you're going, everyone internally knows that. Brand isn't necessarily an obvious focus for a B2B company. That a lot of them sort of grow up and they get incredibly large without having a core identity and core brand expression. If you're customer facing, that's a natural and that's sort of already established, but it also becomes incredibly important if you need to think about where are you going and what are you changing to? Oftentimes people come to us because they need to rethink what they are going to be in the future and how does their brand ladder up to where they see themselves going.
In this current moment, what's driving people to rethink the need to come up with a new brand or come up with a new story?
I mean, I think it's a range of things. Sometimes it might be a customer or company that's maybe on the more mature side, and they're thinking about what is our next step? How do we take our legacy and what's great about who we are and shape that into the next chapter? It also can be people who are thinking about they're going from B2B to B2C, so they might want to think about we have a great customer base. People know who we are in our industry, but people outside don't know how we are, and we don't know how to communicate that. And it might be somebody who's looking to increase their TAM. They know that they're good at something, but they want to expand. They need to know what are the right places to expand, where is the white space, and how should they be thinking about their brand as it go forward.
For a company, though, that is mature, how difficult, and maybe hadn't done that already, how difficult is it to sort of get that up and running?
You know, I think it's honestly a top-down thing. If the CEO and everyone is actually galvanized and excited about that, it can be incredibly easy. If there is resistance, it can be challenging. I think it's scary to change. I come from a world where change was all we did, and it's something that I actually take great pride and I enjoy. It can be very frightening, particularly if you've made money, you've established yourself in one career, one type of product, and now you need to shift. So I think getting over that fear and realizing that change is good. The world is changing. We're seeing AI and what it's doing to businesses across the board, and it's impacting everything we're touching.
On that point of change, though, too, what about a brand that maybe falls on hard times or gets tarnished in some way or another for a variety of reasons? What does that process look like to either rebrand or at least to clean up the brand?
I mean, I think it's a First is it's diagnostics. It's really sitting down and saying, where is the juggernaut? What's stopping you from rethinking who you are? A lot of times what happens is there's a legacy CEO or someone who started the company, and maybe they actually were the ones who were the designers behind the company. They really developed the product, and now they're either exiting or they're just afraid to change. So some of it is really diagnostics at the beginning, and then starting to identify what are the opportunities and how do we actually get them to be comfortable with those opportunities. The biggest thing I think is really important, having sat on the inside and experiencing people coming in and doing this kind of work with us when I was at J.Crew, is that I know what it's like to be on the other side. It is incredibly important to bring the team along, make people feel heard, seen. It is not just about the CEO. We need their buy-in. But what's absolutely critical is reaching all those people who are doing the work and making sure that they feel brought along and they understand where we're going and they get it. And if they don't, then we're just handing over a deck that doesn't go anywhere.
Right. You got to get buy-in from everyone, essentially.
Yes.
So I was going to ask you how Fundamentalco is different from an advertising agency, but I think that's too basic a question. Where does an advertising agency's role come into this process?
I mean, that's interesting that advertising agencies are something we might hand off to. So what we're really thinking about is how do we connect brand to the actual strategy of the company, and how do we think about enterprise value? How do we think about growing the value of the company? So we're not just looking at an advertising, it's not just brand at the end. We're trying to get brand upstream, get it a seat at the table and say, listen, brand is your organizing idea. Everyone internally needs to understand what you stand for, what your purpose is, and what are your advantages, and then how do you utilize those, and making sure that you're actually delivering a consistent message. Then that's when we turn over the message, and that's where the advertising comes in.
And you outsource it.
Some of it, not all of it.
But how does the customer want to be spoken to? I mean, we've spoken with a couple other CEOs earlier today, and they talked a lot about community and just how things have changed. You know, it's not just about putting the celebrity out there to push whatever product there is. I mean, what is the customer asking for? How do they want to be treated?
It's such a good question, and I'm happy they're asking because it has changed. I think, I grew up in a world where we had direct connection to the customer, and what we're seeing is that more and more people are looking for community. They are looking for they're looking for touch. They're looking for something to say, someone touched this. While they want efficiency and they want privacy, they want intimacy. They want to feel like something is for them. They want to feel like something is more bespoke. So it's a really interesting dynamic because in order to be bespoke, I have to know a lot about you. So how do you do that in a way that doesn't cross that barrier, making someone feel like it's...
Is it easier to do that now given, you mentioned AI and just we are in such a more of a data-driven world today. Is it easier to do that?
In some ways, yes, and in some ways, no. Obviously, there's this barrier and real sort of understanding of where does privacy and intimacy, where do those two things connect? How do you think about reaching that customer and making them feel seen and giving them what they want without being intrusive? And it's an interesting dynamic.
All right, Jenna, well, you're obviously one of the best at it, and appreciate you being here today. Jenna Lyons, she's a partner over at Fundamentalco. All right, stick with us. A lot more coming up on the program, including setting you up for what to watch next week. This is Bloomberg. As we wrap up a whirlwind week, we push ahead to what the markets will have their eye on next week, and that starts on Sunday, and new leadership in Canada.
Yeah, will it be Chrystia Freeland? Will it be Mark Carney? Lots of questions. And of course, then there's going to be an election after that. Yeah, Justin Trudeau set to step down. His Liberal Party set to name a new leader. But of course, elections likely to be held within the next couple of months for longer term leadership. On Tuesday, we are going to get some economic data, those JOLTS job openings, and we're going to get earnings out of a few key companies. Volkswagen will be reporting. That'll be interesting, especially with its move towards electric vehicles. Dix and Kohl's for a further read on the consumer in a time when tariffs are top of mind. And also top of mind will be inflation. On Wednesday, we get that monthly CPI report. Yeah, it's expected to increase 0.3% month over month. On a year-over-year basis, increase at least 2.9%, and core increasing by 3.2%. And that report comes on the same day that those new tariffs on steel and aluminum imports are scheduled to kick in, so potentially inflationary there. And maybe that's a setup here for Thursday when we get the producer price index as well as jobless claims. ECB President Lagarde will also be making comments, but they've already cut rates. We already know that that's part of the picture. And then on Friday, did you know there's a government shutdown? I did. We are going to get another deadline here on the budget front out of Congress. We're also going to get another read on consumer sentiment numbers that have been dipping. That does it for us here on The Close. Balance of Power is up next, right here on Bloomberg.